So, picture this. It's late July 2026. The Japanese yen just slid to a 4-decade low. I mean, 164 to the dollar.
Which is just wild.
Yeah, and then seemingly out of nowhere, the United States steps in to orchestrate this really rare joint intervention to save it, which begs the question, why would America intervene to support a foreign currency?
Well, it's a tangled web.
Okay, let's unpack this. Why was the yen crashing so hard to begin with?
So the catalyst was this massive interest rate gap that was basically driving what we call the carry trade.
Right.
You had U.S. rates sitting at like 3.50 to 3.75%. Meanwhile, Japan's were still way down around 1%.
And capital naturally flows to higher yields, obviously.
Exactly. So investors were borrowing cheaply in yen to buy U.S. assets. By mid-2026, we're looking at $12.5 billion in speculative short bets just stacked up against the yen.
Wait, hold on, though. I remember from Econ 101 that a weak currency is supposed to be a gift for an export-heavy country like Japan. You know, cheaper cars and electronics for the rest of us.
Yeah, textbook theory.
Right. So why were they suddenly panicking?
Because that theory totally ignores Japan's critical vulnerability.
Yeah.
They rely heavily on imported energy and raw materials.
Ah, I see.
And you throw in Middle East tensions driving up oil prices, and suddenly a weak yen meant their import bills were just skyrocketing.
So inflation was basically squeezing households.
Yeah, exactly. And the real trap here is that Japan couldn't pull the standard central bank lever. I mean, they couldn't just raise interest rates to defend their currency.
Because their entire economy and, not to mention their massive government debt, relies entirely on ultra-low borrowing costs, right? Raising rates would just crush their own growth.
Yep. Which leaves them with really only one realistic option, which is to buy yen directly in the currency market to prop it up.
But to buy yen, you need dollars.
And a lot of them.
Which brings us to the $1 trillion American problem. Because Japan holds roughly $1 trillion in U.S. Treasury securities.
Yeah, making them one of America's largest foreign creditors.
Right. So here's where it gets really interesting. If Japan needs cash fast, they have to sell those treasuries. It's kind of like a company's largest investor threatening to liquidate all their stock just to pay a personal tax bill.
And the stock price would just plummet.
Exactly.
Yeah.
So Washington was suddenly staring down a severe American bond market crisis.
Right, because U.S. fiscal deficits were already elevated and Treasury issuance was rising.
Right, right.
So if Japan dumped billions in U.S. Treasuries onto the open market to buy yen, it would create this massive supply glut. Bond prices would crash.
And U.S. borrowing costs would absolutely spike.
Exactly.
So Washington has to stop Japan from selling, but Japan desperately needs dollars. How do you even thread that needle?
Well, on August 3, 2026, they utilized a workaround called the FEMA repo facility.
FEMA stands for Foreign and International Monetary Authorities, right?
Right. It's essentially a repurchase agreement.
Yeah.
So instead of Japan selling its treasuries on the open market, it pledges those bonds as collateral to temporarily borrow dollars directly from the U.S.
Oh, wow. So that keeps those bonds completely off the open market. There's no supply glut, bond prices stay stable, and U.S. borrowing costs don't shoot up.
Yep, it's clever. Treasury Secretary Scott Bessent actually acknowledged this as a stopgap.
But looking at the sheer scale of the currency markets, I mean, borrowing some temporary dollars can't permanently reverse the macroeconomic tide, can it?
History strongly suggests it cannot. If you look back at the last major coordinated intervention in 1998, you really see the limits of these tools.
How so?
Even if the U.S. deployed its maximum intervention firepower today, which is roughly $330 billion.
That's a huge number.
It is, but that only covers about 17 hours of turnover in the daily dollar-yen market.
17 hours. That's incredibly brief.
Yeah, it's a drop in the bucket. FEMA provides crucial temporary liquidity, sure, and it sends a strong signal to the market, which can squeeze the short sellers for a bit.
Right, to buy some breathing room.
Exactly.
Yeah.
But it doesn't change the underlying interest rate gap. It's a bridge to buy time, not a permanent destination.
Right. So what does this actually mean for you? Ultimately, this intervention wasn't a rescue mission for the yen.
Not at all.
It was a defensive maneuver to ensure stability in the treasury market and preserve foreign demand for U.S. assets. Keeping that global electrical grid online meant making sure a major player didn't just short out the American foundation.
Yeah, and it really highlights a hidden vulnerability in the system. The U.S. economy relies heavily on foreign nations holding its debt.
Which means their domestic crises can become our domestic crises very quickly.
Almost instantly, yeah.
Which leaves you with a final thought to mull over. If America must actively manage foreign currency crises just to protect its own debt market, is the dollar's dominance truly based on economic might, or is it just a fragile dependence on global financial plumbing?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.